There is a number on the second line of your pay stub. It is not the number on the first line. The first line is the salary. The first line is the number you tell people at parties, at family dinners, at the small talk before performance reviews. The first line is a story about you. The second line is the truth. The second line is what actually arrives in your bank account every 2 weeks, after the federal government and the state and Social Security and Medicare and your 401k contribution and your health insurance premium and the dental you have not used in 3 years have all taken their cut. Today, we are going to walk through 5 second-line numbers: $40,000, $80,000, $150,000, $250,000, $400,000, 5 gross salaries, 5 different lives, 5 different versions of the same Tuesday morning, or separated by what arrives in the account, what the rent is, what the trap looks like, and what the unlock is. The one specific thing that gets you from this tier to the next. We are not going to tell you that any of these numbers will make you happy. Most of them will not. But each of them will rearrange your life in ways you will only notice at 11 p.m. on a Sunday, lying in bed, staring at the ceiling, calculating something the calculator was never designed to calculate. Let's start at $40,000. $40,000 a year. Bureau of Labor Statistics says the median U.S. worker makes about $48,000, so this is below the median. But it is what 35 million Americans take home before tax. After the standard deduction, federal income tax is roughly $2,800. FICA, Social Security and Medicare, takes another $3,060. A state income tax depends on where you live. 0 in Texas or Tennessee, about $1,400 in Colorado, about $2,000 in New York. Health insurance through your employer, even with the subsidy, takes maybe $1,800 a year for a basic plan. With a $4,000 deductible, you will spend the year hoping you do not need. Your take-home, after everything, roughly $2,650 a month. Sometimes $2,700. Once, when there were 3 pay periods in a month, $4,000, and that is the month you bought the new tires. At $40,000 a year, the rule says you spend 30% of gross on housing. That gives you $1,000 a month. In Austin, $1,000 gets you a studio in a building 20 minutes from anywhere you actually want to be. In Denver, $1,000 gets you a 1-bedroom basement apartment with a separate entrance and a landlord who does not return calls. In New York City, Brooklyn, on the parts of Brooklyn nobody is writing think pieces about, $1,000 gets you a room in a 4-bedroom apartment with a bathroom you share with 3 people, 2 of whom you have never met. So you spend $1,200, sometimes $1,400. The 30% rule is a thing personal finance books were written about. The 30% rule is not a thing that survives contact with the actual rent in actual cities in 2026. The moment you notice the income at $40,000 is the moment at the CVS counter when the clerk asks if you want to round up to the nearest dollar for the children's hospital. You say no. You say no for the same reason you say no every time. The 47 cents matters. The 47 cents is the difference over the course of a month between the bus and the gas. You are aware that this is irrational. You are aware that the 47 cents will not mathematically change your life. You also know that if you start saying yes, you will say yes to other things, and the things will compound. And the compound is the part that ends you. You walk out of the CVS. The clerk does not remember you said no. You will remember saying no for 9 more hours. The trap at $40,000 is the credit card with a 0% introductory APR. It will not stay 0%. It will become 24.99% at month 13. You will know this. You will plan to pay it off before then. You will not. The minimum payment will become a line on your monthly budget that you stop questioning, because questioning it does not make it go away. The trap is not the credit card. The trap is the structural fact that at $40,000, there is no margin for the unexpected. The car repair, the medical copay, the wedding you cannot afford to attend but cannot afford not to attend. And the credit card is the only product the financial system has designed to absorb that gap. The unlock from $40,000 to $80,000 is not the side hustle. The side hustle is what people who have already escaped tell people who have not yet escaped. The side hustle, at $40,000, is a way to spend your last 2 evenings a week earning $14 an hour after taxes, and the math, when you actually do the math, breaks even or worse. The unlock is one credential. One specific credential, the certification, the associates, the trade license, that pushes you into a job category whose median pay starts at $60,000 instead of $40,000. The credential takes between 9 and 24 months. It is not glamorous. It is not what the internet tells you to do. It is what the data, the BLS Occupational Outlook, tells you to do. It is also the only unlock at this tier that has ever statistically worked. $80,000 a year. This is the median household income in the United States. It is also, increasingly, the income required for a single adult to live what their parents would have called a normal life in any city with a real economy. Federal tax after the $15,750 standard deduction, about $7,300. FICA, $6,120. State, depending, $0 to $4,000. Health insurance, a slightly better plan, $2,800. A 401k contribution at 6% to capture the match, $4,800. Your take-home after everything in a no-state tax state, about $4,600 a month. In California or New York, closer to $4,200. At $80,000, the 30% rule says $2,000 a month for housing. In Austin in 2026, $2,000 gets you a clean one-bedroom in a building that has a gym you will visit twice. In Denver, $2,000 gets you a one-bedroom with a balcony in a neighborhood with a coffee shop that knows your order. In New York, $2,000 gets you a studio in Astoria or a shared two-bedroom in a part of Brooklyn that has, in the last 6 years, become the kind of place that has a cocktail bar that does not serve cocktails before 6. So you spend $2,200. The number that was a hard ceiling at $40,000 has become a soft ceiling at $80,000. And the soft ceiling is, in some ways, worse, because the math still doesn't quite work, but it works closely enough that you stop running it. The moment you notice the income at $80,000 is in the security line at the airport. The line is long. There are 2 lines. The shorter line, TSA PreCheck, is moving 4 times faster. You pay the $85 every 5 years. You walk through the shorter line. You take exactly 17 seconds to be reminded, again, that you can buy time now. Not a lot of time. Enough time to notice. You will not tell anyone about this feeling. The feeling is too small to share and too specific to forget. The trap at $80,000 is the car payment. The math says you can afford a $36,000 car. The dealership has a 72-month loan at 7.4% that gets the payment down to a number that sounds reasonable when said out loud. $620 a month. You sign. You drive home. You feel, briefly, like you have arrived somewhere. For the next 6 years, $620 a month is gone before it arrives. Across the loan, you will pay roughly $8,800 in interest. The car will lose $14,000 of value in the first 18 months. The math, on a spreadsheet you will not open, will reveal that the car has cost you approximately $50,000 over 6 years for the privilege of looking like someone who makes $120,000. This is the most common single financial trap in the American middle class. It is not the houses people buy. It is not the vacations. It is the car. The unlock from $80,000 to $150,000 is your relationship with one specific person, your manager's manager. The skip level, the person 2 rungs up, the person whose calendar you have access to but rarely use. The data on internal promotions is unambiguous. People who jump from $80,000 to $150,000 do not do it through performance review feedback from their direct manager. They do it through visibility, the lunch, the cross-functional project, or the deck that gets sent up the chain that the skip level approves. Your direct manager wants you to be good. The skip level is who decides if you are next. The unlock is not working harder. The unlock is being seen by the second decision maker. $150,000 a year. This is approximately the 80th percentile of individual income in the United States. It is the income level the internet calls comfortable, and your friends call rich, and your accountant calls the bracket where it gets interesting. Federal tax, about $24,800 after the standard deduction. FICA, $9,968. Social Security caps at $176,100 of wages in 2025, so you are still paying it. State, $0 to $11,000. Health insurance, $3,600. 401k at 10%, $15,000. Your take-home in a no-state tax state, about $7,900 a month. In California or New York, closer to $7,000. At $150,000, the 30% rule says $3,750 a month. In Austin, $3,750 buys you the mortgage on a $560,000 condo, taxes, and HOA included. In Denver, $3,750 buys you the mortgage on a $580,000 townhouse in a neighborhood with a name. In New York City, $3,750 rents you a one-bedroom in Manhattan if it is north of 96th Street, or buys you the maintenance fee on a co-op you cannot afford to actually buy. So you spend $3,400. For the first time in your adult life, the housing payment does not exceed what the personal finance book said it should be. You feel, briefly, like a person who has read the books and applied them. The feeling is real. It is also, you will discover, the high water mark of the book's usefulness, because every recommendation past this tier is calibrated for problems the books were never designed to solve. The moment you notice the income at $150,000 is at dinner with a friend. You order an entree. They order an entree. You order a glass of wine. They do too. The check comes. It is $94 each. You do not flinch. You do not check the math. You hand the server your card without a glance. It is the not glancing that gets you. 3 years ago, at $80,000, you would have glanced. The glance was a piece of architecture in your life. Not glancing is a different piece of architecture. You drive home that night, not because anything has changed in the world, but because something has just changed in you, and you do not yet know whether the change is good. The trap at $150,000 is what economists call lifestyle creep, and what your accountant calls your savings rate. At $80,000, you saved 9% of gross. At $150,000, you save 11%. Arc the percentage barely moved. The dollars moved a lot, $7,200 a year to $16,500 a year. But the rate, the thing that actually determines retirement age, is approximately the same. The reason is not vacations or restaurants. The reason is fixed costs. A bigger apartment, a better car, the dog, the therapy, the gym membership that includes the cycling class. Each of these decisions made sense in isolation. Together, they consumed the entire raise. You are not behind. You are exactly where the data says people at $150,000 end up. You are also not as far ahead as the income suggests. The unlock from $150,000 to $250,000 is leaving, not the company. The role. The data on income jumps in the $150,000 to $250,000 range is unambiguous. Lateral moves to a different employer in the same industry at a slightly different function account for the majority of the jumps. Internal promotions in this range average a 9% raise. External moves average 23%. You will not hear this from your manager, who has every incentive to retain you. You will not hear it from your skip level, whose calendar you now have access to. You will hear it from a recruiter you did not ask to be contacted by on a Wednesday in a LinkedIn message you almost did not open. The unlock at this tier is mostly the willingness to take that call. $250,000 a year. The threshold the IRS calls high earner. The threshold past which the math gets complicated and your friends from college start asking about your accountant. Federal tax, about $52,400. FICA, $14,000. You cross the Social Security wage base mid-year, so the rate effectively drops on the back half. State, $0 to $22,000, or health insurance with HSA, $4,200. 401k maxed at $23,000. Brokerage contributions, after tax, now possible for the first time at any reasonable rate. Your take-home, no state tax state, about $13,200 a month. California or New York, closer to $11,800. At $250,000, the 30% rule says $6,250 a month. In Austin, $6,250 carries an $850,000 house, taxes, and insurance, in a neighborhood that has both an HOA and a coffee shop with latte art. In Denver, $6,250 carries a $920,000 house in a neighborhood that has views. In New York City, $6,250 rents you a two-bedroom in Manhattan below 96th Street, or carries the maintenance and mortgage on a one-bedroom co-op in a building with a doorman whose name you will, this time, eventually learn. So you spend $5,800. The 30% rule, for the first time in your adult life, has more headroom than you expected. This will last about 14 months, at which point the headroom will be absorbed by the private school, the bigger car, or the renovation. The moment you notice the income at $250,000 is on the flight home from a wedding. You upgrade to first class. Not on every flight. On this flight, because the wedding was draining and the flight is long and the math you have been running for 15 years on every airfare, has briefly stopped running. The seat is wider, the drink is warm. You sleep for 28 minutes, which is 28 more minutes than you slept on the way out. You realize somewhere over Kansas that you are not sure you can ever go back to the other seat. Not because the other seat is unbearable, because the going back, the act of choosing it again after having known the alternative, is a kind of friction you have spent 15 years building income to escape. The income did not buy the seat. The income bought the absence of the question about the seat. The trap at $250,000 is the house. Not the house you bought, the house you bought next. It happens around year 3 at this income. You move from the $750,000 house to the $1.4 million house. The mortgage doubles. The property tax doubles. The maintenance doubles. The cost of furnishing the rooms you do not use doubles. You are now spending 38% of your gross on housing. You are also at the income tier where 38% on housing produces the same monthly free cash flow you had at $150,000. On the income raise, $100,000 over 4 years, has been entirely absorbed by the second level of the same trap that sat under you at $80,000. The trap, at every income level, is the same trap. It is the version of the trap that scales. The unlock from $250,000 to $400,000 is no longer about the W-2. The W-2 has a ceiling. The ceiling in most industries is approximately $400,000, and the path from $250,000 to $400,000 on a W-2 alone takes, on average, 8 to 12 years, plus a willingness to manage people, which not everyone has. The unlock is equity, a partnership stake, a consulting business with retainer clients, a side business you formalize, a real estate position that produces K-1 income, stock-based compensation at a company that is going to liquidity in 3 years. The data on the $250,000 to $400,000 transition is unambiguous. It almost never happens through a single salary raise. It happens through stacking the W-2 you already have, plus one more income stream that your CPA, not your manager, optimizes. $400,000 a year. The income level approximately equal to the top 1.5% of individual earners in the United States. The income level the IRS uses as the threshold for high net worth planning. The income level past which the rules of personal finance, mostly, stop applying, and the rules of business finance, which nobody taught you, take over. Federal tax, about $99,000. FICA, $19,400. State, $0 to $38,000. Health insurance, $4,800. 401k maxed plus Mega Backdoor Roth, if your plan allows, $46,000. HSA maxed, $4,150. Brokerage, now substantial. Your take-home are in a no-state tax state, about $19,200 a month. In California or New York, closer to $16,400. At $400,000, the 30% rule says $10,000 a month. In Austin, $10,000 carries a $1.6 million house in a neighborhood with a private school. In Denver, $10,000 carries a $1.7 million house in Cherry Creek or Park Hill. In New York City, $10,000 carries a two-bedroom pre-war co-op on the Upper West Side, or rents you a three-bedroom in Tribeca, or buys you a townhouse in Brooklyn that needs $400,000 of work that nobody has told you about yet. So you spend $8,400. The number is, finally, less than the 30% ceiling, because at this income, housing has stopped being the primary financial decision of your life. The primary financial decision has become tax structure, which is a sentence you would not have understood at $80,000, and which will define the next 10 years of your financial life in a way the rent never did. The moment you notice the income at $400,000 is at the school drop-off line. You are in the car. Your kid is in the back seat. The school is private, $42,000 a year, and the drop-off line is full of cars that cost more than your first house. You used to feel, in this line, like a fraud. You no longer feel like a fraud. You feel now like one of the cars. This is not a triumphant feeling. It is closer to the feeling of finally fitting into a piece of clothing that your mother gave you 8 years ago, that you tried on every year, that finally fits. Not because the clothing changed, but because you did. And the change was so gradual you did not notice until it was already done. You drop your kid off. You drive home. You think, briefly, about the version of you who, at 25, would have looked at this version of you with a kind of distance that you no longer know how to bridge. The trap at $400,000 is identity. At $40,000, the trap was the credit card. At $80,000, the car. At $150,000, the lifestyle. At $250,000, the house. At $400,000, the trap is that you become the income. You start measuring yourself against people who make $800,000. You start dismissing the version of you who made $80,000, even though that version of you, statistically speaking, was happier, slept better, and had clearer relationships. You start feeling behind in a peer group that did not exist, in any conscious form, when you made $150,000. The trap is not that you spend more. Even the trap is that the income becomes the center of the story you are telling about your life. And once it becomes the center, it cannot be moved without the entire story collapsing. There is no easy unlock from this trap. Most people who enter it do not exit it. The exit, when it happens, is rarely a financial decision. It is almost always a non-financial event, an illness, a death, a child, a near miss, that interrupts the story long enough for a different story to begin. The unlock past $400,000 is no longer an unlock about income. Past $400,000, the data on happiness flatlines. The data on stress climbs. The data on relationships gets worse before it gets better. The data on what people actually want, time, autonomy, presence, does not improve further with each additional dollar. The unlock past $400,000 is the willingness to ask whether the income is still serving the life or whether the life is now serving the income. That question, at $40,000, was a luxury. At $400,000, it is the only question worth asking. 5 income levels. 5 take-homes. 5 housing realities. 5 micro-scenes. 5 traps. 5 unlocks. The $40,000 version of you and the $400,000 version of you are not the same person. The income did not just change the bank account. It changed what you noticed. It changed what you defended. It changed which traps you saw coming and which ones you walked into without noticing. The income doesn't change who you are. It changes what you have to defend. At $40,000, you defend the $47 at the CVS counter. At $80,000, the 17 seconds in the airport line. At $150,000, the dinner check you do not glance at. At $250,000, the seat on the airplane. At $400,000, the version of yourself that the income has built around the version of yourself that arrived first. The defense is not optional. Every income level requires a defense. The question is not whether you will have to defend something. The question is whether the thing you are defending is the thing that, on a Sunday night, lying in bed, staring at the ceiling, you would actually choose. Next week, the inverse of this video. The income you did not earn and the obligations you did not sign for. Generational debt. The kind that arrives, already attached to your last name before you have made a single financial decision of your own. Subscribe is below. The next video is already in the calendar. Until then.